Despite the external disruption, our focus remained on building a scalable, resilient, and profitable platform. And we believe the groundwork laid this year positions us strongly for the future. Now I'll hand over the call to Vishesh, our founder and CEO, who will walk you through the broader business highlights, strategic directions, and key milestones for the for the second half and for the full year. Over to you, Vishesh.
Thank you, Ashish. Hi, all. Thank you for joining our earnings call. I hope I'm audible to all of you. And I hope you can see the presentation on your screen. Just 1 minute. I think this other one. The link. The link.
Allow us for a notice.
Presentation time. Sorry for the disruption. Just give me 1 minute. Yeah. Sorry for the disruption. I think I had the wrong presentation. I hope you can see the screen. So to start off, just for the uninitiated, Newjaisa is a full-stack PC refurbishing company catering in the Indian market. FY24-25, we saw a revenue growth of 5% in EBITDA, and the EBITDA ending at rupees 65 lakhs. We will look at the salient features, what led to this. As Ashish also mentioned, this 24-25 has been a mixed year for us. Also, we faced challenges in our as a primary revenue driver. Amazon as a marketplace took a decision to not sell any refurbished products across any categories from March 25. And as Amazon was contributing almost 60% of our revenues, it had a significant impact on our revenue and profitability. We want to also call out the first 10 months before Amazon decision. We were able to show reasonable growth at a 25% on a year-on-year basis. In this year, we also added one more facility for our desktop refurbishment in Bangalore itself. And also we received e-waste certificate that allows us to directly procure e-waste material from Indian corporates. Our R2 certificate, which is an international certificate, we have also received that on provisional basis. Pending certain payment, we should receive it very shortly. So we will be discussing about other significant achievements for this year. Just to call out the last point, we continue to invest on technology and diversification of the sales, and we'll talk about it as we continue with the presentation. So looking at the numbers, so these numbers must be available with all of us. Key things to call out here is we were expecting to almost end the year if we would have been able to continue with the growth trajectory which we had at approximately 73 to 74 CR, given our Jan trajectory. However, because of the Feb and March sales losses, overall growth has been at 5% as such. In terms of overall units sold, we approximately sold 50,000 units, right, in this year as compared to 54,000 units that last year. This is also driven by a better product mix for us as we sold slightly more laptops as compared to the last year. In terms of overall numbers, as you can see the revenue, right? In terms of employee cost, because we continue to build the momentum, overall employee cost increased by around 30% for us. However, we were able to control the other expenses. Overall, like our EBITDA came down significantly, largely because of the events that happened in the last 2 months. This is just to share with the group some key insights in December, Jan, Feb, and March, and how it impacted our business. First key point that we want to call out is that, as you can see in December and Jan, so the blue bar is your revenue or the gross margin, and the next bar in adjacent to it are our cost drivers as such, right? As you can see, from December to Jan, we were on a reasonably good growth traction. However, because of the decision that was taken by Amazon, we saw a very steep dip in overall top line in February and March. Third point that we want to call out that as this event happened in this financial years, right? Another key aspect that impacted our profitability is almost 90 lakh of goods to be received from Amazon were under dispute as have been under dispute for being stolen by their third logistic partner. The case is under arbitration, but following conservative financial practices, as of now, we have taken it as a markdown on our books. That has impacted. So that shows in the point 3, which is the inventory rationalization that we see. At the same time, we had a very critical look at the inventory which we have with us, and also marked down on the spares, excess spares, aging spares, and some aging inventory that we are holding. So the purple color, the bar that you see on the cost structure, are kind of a one-off markdowns that we are building, build in our financial statement, assuming a contingent liability of and almost 2.5 crore of a inventory markdown because of assumed depreciation and aging. At the same time, as you can see from Jan, Feb, and March, though the revenue came down pretty significantly, largely because of the Amazon, in terms of our cost structure, both the employee cost and the fixed cost, right? We immediately had, the management leadership meeting. We have already drawn on a plan in terms of cost rationalization that helps our business to sustain and build on that. Having said that, doing employee rationalizations do take time, right? Because of the labor laws and other activities. And that's the reason if you see though our revenue came down, our fixed costs and our employee costs continued on like the similar trend. These are the reasons we had to incur significant losses in month of Feb and March, that along with the inventory markdowns because of the conservative approach that we have taken. And that's what we have highlighted in the results that we have shown this time. Just to keep the group updated with how does the plan or the road ahead looks like, right? Many of you definitely joined the call which we had once the Amazon event happened. And if we recall, we talked about our 4 pillars of growth, and we also alluded on that though there will be a short to medium term pain, but it potentially can open an opportunity for us to fill that white space, right? So we had a 4-pillar strategy in terms of sales growth, right? First was grow your own online business to cover the white space that has been created in the online business with Amazon going away. Develop and focus on the enterprise and SME segment, focus on the education sector, leverage offline distribution, modern trade, and franchise model. As we go along, I would like to update the group on the progress that has been made on this before we open the call for Q&A. This is again the blue chart or the bars that you see are the revenues, or I would say are more of a trend line of the revenues. As you can see, moving on a month-on-month basis. The other column that you see parallel to that are our cost structure, which stands as of now. We have already discussed about December, Jan, Feb, and March, and how our revenue from profitability in Jan, right, dipped to losses in February and March. In April, May, and June, be able to grow channels by almost 100%. Looking at like the bottom in April to where we stand as of now in June. So as you can see that the revenue has been strongly going up. Call out that in terms of fixed cost, it continues to be on a higher side, largely because of the plan actually could have been double to where we as of now stand, right? So that continues to the employee cost, and the fixed ancillary expenses continue to impact our bottom line. But as you can see, we continue to strongly bridge the gap between the two. You can also see that the decisions in terms of employee count, we have like reduced by almost 25% now. The decisions were taken in March. The actual impact to call out that as a company will continue to pivot because we look at it as an opportunity to fill the white space and grow the market, and we continue to be committed towards spending on marketing, bringing in more awareness about these products, right? So we will continue to over leverage on ATL and BTL, though we'll try to be as realistic when it comes to the cost structure. Taking group a bit more, so as you can see, right, and from March, April onwards, right? So the blue one is our website. Website, we have seen almost 100% growth starting from March to June, or 60% growth, right? We have seen very strong traction on our other channels, which literally didn't existed in March, which includes our B2B or the enterprise segment, education sector segment, and the retail. As of now, it has from 1%, its contribution has already increased to 40% of the overall revenue. These are some of the key matrices or the key drivers what helping us drive the revenues by almost 300. So we continue to be online first. Our strategy continues to be online presence using the social media. Growing online first. Our website traffic has grown by almost threefold. Our social media has grown by 3 to 4 folds now. Also want to call out that in terms of pin code serviceable from our website, we have expanded it from 5K to 20K, which is pretty much now with Amazon. Our sales team, we have increased from 15 associates to now 5, right? Very strong.
Hi, Ashish.
And we are growing it almost at a 5, right? And so the tech influencers and
We can't hear anything. Can somebody please check the line?
Sure. 1 minute, I'm checking the line.
In fact, we missed everything about the last two slides, so we didn't get most of it. We couldn't hear anything.
Yeah. Give me 1 minute. What's program? Let's see if it is. Is it better now?
Yeah, much better.
Yeah, can you go back to the previous slide and start again, because we couldn't hear anything earlier.
This one?
No, Vishesh, I believe your voice is still breaking up. I think there's some issue with it.
Yeah, so I'll start from here.
Yeah.
Give me 1 minute. Connected. There's a present from your side. Yeah, is it better?
Yeah, we can hear you now.
You can hear? All right, great. So I'll just recap quickly this slide. So this is just to show our growth for the starting from March this year. As you can see that our own channel has grown by almost 100%. All like the four pillars of success that we discussed about, including website has grown by almost 60% now, and the other channels which include B2B, education sector, and retail, right? They're now almost contributing 40% of the overall revenue. As such, we'll deep dive into like each of those channels. In terms of driving traffic or like our own website, as you can see that there is a 5-fold increase in terms of visitors to our website. Largely, this is driven by 2 or 3-fold strategy by us. We are definitely leveraging on social media, right? Our social followers are increasing on a quarter-on-quarter basis, have increased by 3x on Insta and Facebook as such. We have tied up with a third, with a media partner who are helping us in terms of performance marketing. So the strategy is both twofold, like BTL and ATL. We strongly believe that we'll continue to spend on ATL because to create awareness or do the brand marketing as such. As you can see here, other significant factors is that definitely in terms of our coverage and the service offering to the end customers, we have definitely filled all the gaps that we can identify between our website and Amazon. For example, now we are able to serve 20K pin codes. We have already introduced COD, which was not available in all the pin codes earlier. We have tied up with an EMI option. We have tied up with Bajaj Finance, so that all the ads in terms of providing the features to the end customer, we can now say that we are at par with any of the marketplaces as such, right? In terms of team size, we've increased from 15 to 30 now, and definitely that's helping us to grow our sales on the website. And we remain pretty confident that as we continue to invest on this as a channel, this will continue to show strong results for us. Another key aspect that I want to call out to the group is that our increase in the in-store sales. So if you look at the third graph here, right? So from as low as 5 units a day or less than 1 unit a day. So right now we are running around 5 units a day kind of a run rate. on our own in-store in Bangalore, which is significant, like a 5x increase. More importantly, this is kind of a pilot for us, that if we can drive this kind of a in-store scale from one or two pilots that we are doing, we will be able to scale this particular model across, like pan India, and in a profitable manner. So this was one of the pilots that we were driving, and we are very happy the way results have come out. So moving forward, these are like just some of the snapshots of the things that we have been like doing. We have been, like collaborating with the tech influencers. So some of the well-known names as such, and driving those. We have been driving a lot of offline influencing or the ATL stuff, be in some of the busiest places in Bangalore. For example, the last product review, which you see, we did a blind test between our product and a new product on street, and got like very good leverage and uplift in terms of traction on the website, because like people were dazzled to know that you can get like the same kind of product for which at half the price, kind of thing, right? So moving on, enterprise and SME sales. So as we discuss about like the 4 pillars of success, right? So this is the second pillar of success, which we are like we strongly believe that has shown very strong traction to us, and we continue to over invest on that, right? We have just in span of a quarter, we have signed more than 88 new clients now. Out of that, 4 are very large deals, with each deal more than 1 CR, right? One of is the biggest, one of the largest NBFCs in the world, and we're like not in the world, sorry, in India, right? Another is a large media house, both on the FM space and other multimedia space, and these are like like pan India multi city deals, right? And we strongly believe that like Newjaisa being a corporate that is able to provide refurbished products with quality service pan India, makes us stand apart as compared to any other alternatives when people are in the enterprise segment, right, are looking for such solutions, right? So if you look at those like 4 deals, I think that really makes us stand out, because probably we were the only player who had the capability to provide AMC pan India, and like the players who are looking for their multi-location support as such prefer to go with us in spite of a price differential as such, right? We have already strongly started with the B2B campaigns that are showing strong traction to us. So as you can see, I think good thing is, we have been able to like we have a good qualified lead and a closure. So our pipeline looks very, very strong. We pretty much can say that we started in May with this, and it's showing like pretty good traction for us as such, right? Needless to say, June has been like a pretty significant month, where I think like 40 to 45% of sale has just come from the enterprise segment, right? And it's showing like a good traction for us. On the distribution front, I think very honestly, we have just started. There's a lot more to be done here. We discussed about like Purvika, so this is just one of the snapshots there. We are already in 35 plus large format stores for them. We have signed distributions in Maharashtra, Gujarat, Telangana, but many of them have been done in just in the last month. So this will still show. It will take time for this to start, like converting into real sales and showing the numbers as such. Also, we have signed up with one of the large multi chain in Karnataka, so that we can do a good pilot of offline pilot in Karnataka, and then scale it from here. So this channel, I think we have made strong progress, but in terms of translating to sale, we believe from July we should start seeing the numbers coming in as such. In terms of education sale, we onboarded like 1% dedicatedly focusing on this. We have already closed like 2 large deals with engineering colleges and 5 with schools just in the like around Karnataka as such. And we have built a strong pipeline in that regard. And so again, I think this channel also is looking very, very promising to us, with a strong lead, like a strong pipeline that we have been able to build so far. These are the overall numbers from H2 to. I'll just finish with this, and then we'll open for just have a closing comment, then we'll open for Q&A, right? So on an H2 to H2 like basis, yeah, we saw a dip in the gross margin. This is all largely driven because of the like the kind of the conservative approach and the Amazon like stock that we have taken on arbitration and have kind of written off as such. Along with that, because our employee costs, we were on a growth path, right? Continue to remain like on a higher side. Overall, we ended up with a negative EBITDA margin. In terms of in terms of like closing comment, I want to like call out a couple of things. Like as we showcased from March to now, we have already seen 100% growth on our own channels. B, though we had four pillars, the third pillar which has started now driving, which is the distribution and modern trade, the results of that has to still start contributing. So we are very hopeful that this positive momentum should only like continue to build more. Third point that I want to call out is that we are in a manufacturing business. Some of our costs continue to be fixed, right? So there is a bare minimum scale that we need to reach when the contribution margin on the per unit basis starts covering off that cost. We have rationalized the cost when it comes to the employee base as such, but we have been prudent, and I think the bias strongly is more towards growth and not just to go on a conservation mode as such. Fourth point, which I want to call out, is that as a company, we want to focus on growth in this year, though this year is going to be in a year of consolidation. So we will continue to overspend on brand and marketing, right? So that's to share with you how last year and what we have been like focusing on in the last 3 months. With that, I'll hand it over to Ashish.
Yeah, thank you so much, Vishesh. We'll now open the floor for the Q&A session. I request everyone to please use the raise hand option if you like to ask a question. We'll take questions one by one, and Vishesh will be happy to address them directly. Given the limited time, I kindly request you to keep your questions brief and to the point so we can ensure maximum participation. Yeah, over to you, Vishesh. Thank you. So the first question is from Mr. So please kindly. First question is from P.N. Krishnan.
Hi everyone. Hi Vishesh. Thanks for a nice presentation. Glad to know the various initiatives, especially on the B2B segment that you are doing, and also in terms of increasing your visibility through the social platforms. And we all hope that it translates into better performance in the coming quarters or the coming years.
Thank you.
Having said that, a couple of things I wanted to have clarification on. You were mentioning about Amazon having discontinued the sale of refurbished laptops. But even today, when I go on Amazon platform, I see products are being offered.
Sure.
So that is one.
Sure.
The second question is there is a huge inventory sitting in the balance sheet. So,
yeah, what's the
just
plan?
want to understand,
Yeah.
Which is almost equal to 2.
Sure, I'll
numbers.
Sure, sir. I'll take both the questions, right? So to answer the first question, sir, that as per Amazon communication, they have stopped a sale of any. So what basically they're selling now is what is called an unboxed inventory. These are like very low in quantity. How it works is, let's say if I sell a new product on Amazon and it is returned by the customer within 14 days, Amazon continues to run a program called a resell program, where their team does the QC and relist it. In terms of revenue contribution, when we were running like as compared to the inventory that we used to sell, which largely used to be used and refurbished inventory versus this open box inventory, this is around 5 to 10% at best of the overall refurbished revenue which they used to drive, and that's the reason you still see the inventory there. Coming to your second question, sir, yes, as you rightly mentioned, we did have high inventory levels on our books. I just want to call out on a couple of aspects with respect to that. As we showcased like by Jan, we were on a reasonably healthy run rate, right? So we were around like 6.5 plus kind of a run rate. And keeping that in view, the inventory buildup was there. Definitely, even from that aspect, it was slightly on a like higher side. Having said that, in the last 3 to 4 months, there has been hardly, for obvious reasons, right? So we haven't like bought any inventory, and those inventory levels have come down in the last 3 months. But at the same time, yes, we had high inventory levels. That's the reason we also took a conservative approach in terms of looking at aging inventory and like depreciating the or revaluing them, and which is showcased on our books also.
One question finally is about the license that you procured as a license refurbisher. Now, what is the traction in terms of the business opportunity coming out of that?
Right. So I think we have already, from the time we got the EVS license, already closed 4 deals directly with the corporates. Unfortunately, because as like we all know, we were anyway sitting on a high inventory, right? And largely for the last 3 4 months, there hadn't been much procurement because we already had the inventory. But this definitely puts us. We have a good lead source base and relationships now in place, and as we start to like procure, as we further limit our inventory, this should help us in future. We'll go to the next
Yeah.
caller
All right,
because in
sir.
interest of time. Yeah, Mr. Sumanta.
Yes, sorry. So the next question is from Mr. Anshul Jain. So Anshul, kindly introduce yourself and you can proceed with your questions.
Thank you for the opportunity, Vishesh. We were really looking forward for this. So thank you for the presentation. But just wanted to understand on a couple of things, Vishesh. Firstly, that if you can help us understand on the unit economics of the website sales. What are your what is the split between organic and non-organic traffic on the website currently? And parallel question on what gives you confidence that a customer will buy a 25-30,000 product from your website, because currently you are not doing any brand marketing stuff.
Yeah, we have already started a little bit. Yeah, so good question, right? So I'll like quickly cover on that. So as you saw, like our website traffic has increased by almost 5x, right? Between like like the organic and inorganic, definitely the organic has grown by almost 2.5x. But yes, I mean we are over pivoting on performance marketing on one end, right? So yes, I mean performance marketing is driving the remaining 3x of the growth that you see. The split will be approximately 65 to 35 right now, where 65 would be more of like ad spend basis versus 35, which is more natural in nature. Also, I want to like call out the fact that we also have a dual mode. So to answer your other question, like I think that's the biggest question that we wanted to answer when we like put a bet back in March that will customer buy from us. I think the one of the answers that we have been able to get in the last 3 months, as you can see, that we have almost grown by 100% on like just on the website front. So that does do validation that yes, I mean of course we may not have the brand value which Amazon covers, but it is a very strongly growing channel for us, customers are buying. What we have seen is helping to contribute into that are like 3 or 4 major factors. We have a dual mode sale, so we have assisted and an unassisted sale. So you can come to our website and like you can do a live video call, and one of the assisted guys will help you. So that helps build confidence, trust. You can see the product live as such. We have been very particular in terms of driving customer satisfaction and reviews. We have more than 3,200 reviews with 4.3 ratings, right? So these are like some of the facets that are helping. Second, on the influential or social media marketing, I think that we have seen is giving us like strong like results, in particularly with respect to localized influence marketing. For example, in our right now as we talk, just Bangalore is contributing almost 20 to 22% of our revenue, right? Largely because of like our social media marketing as such. In terms of you asked about how does the like the margins look like or contribution, right? So
Yeah.
want to like call that out, that as I told earlier, we are over leveraging. So for example, Amazon overall used to cost us, including logistics, advertising on Amazon, Amazon commissions and returns, around 12 to like around 11%.
Okay.
Currently, just on performance marketing, our spend levels, including performance marketing, our telesales team, returns and logistics, we are around 13 to 14%, right? That's our BTL. I want to also call out that we are now spending 4 to 5% of our top line on ATL. That includes social media marketing and other branding activities, that some of which you saw, including society, education, colleges reach out, and those engagement reach out, right? So the whole story, I think, to summarize is that yes, on BTL basis, currently we are over leveraged at 2 to 3% as compared to Amazon, and of course ATL is additional 4%. But we strongly believe that these are the spends which, on a unit economic basis, later on will help us to bring it down significantly. When it comes to our education sector, again we are spending on ATL. That includes exhibition events and also LinkedIn and other platforms, and we continue to spend 4% on that. Though in short term it will impact our margins, or rather may cause burn, but we are pretty sure that it will help us to build traction. So good thing is we are able to see traction, right? So our conversion rates are pretty strong when it comes to B2B, and even on the website the conversion rates are reasonably strong as such.
But I checked the SimilarWeb data, which SimilarWeb is a platform which actually compiles data for all the platform in terms of paid and not non-paid traffic. It gets a lot of data from open sources. So there probably data was showing slightly differently than what you said. Probably, obviously, it has its own limitation. So I'll go with that. If I can ask my second question.
Or we'll come back to you quickly.
So just I will complete in 30 seconds, not more than that.
Sure, please go ahead.
Yeah, so just wanted to check on the delay in the public this result declaration. See, going by the remuneration which you are paying to the finance team, I mean, at least the CFO, it is there. I mean, you seem to have a capable finance team to close the books within the prescribed time. I mean, this was disappointing that result was not. To put it in perspective, 99% of the companies of your size would not have uh, a dedicated CFO. Forget about the remuneration per se part. So just wanted to understand on that front that what actually happened there.
Yeah, so yes, I mean there was like a technical glitch on the ERP, because of which like the valuation and that like took us a lot of time, because we have to like look at the overall inventory valuations, right? And that really like put back our like timelines. So we really like apologize for that, but we'll make sure that this will not happen from the next time. So we understand this should not have happened at any cost, especially given this like year. But over like there was like some glitch because of which the valuations were not like
Got it. Okay.
correct. in ERP.
And which ERP you are using currently for accounting? Tally, you said,
We
right?
are using ERP Next. It's an open source ERP, right? So because I think, yeah.
Okay. And for OMS, WMS, are you using any tool, or it is on Excel, or for order management system or warehousing management?
Yeah. So it's an integrated ERP Next is actually like a integrated manufacturing plus like invoicing, financing, everything is inbuilt, right? So yeah, so we use the same system for pretty much everything, and so I yeah, so the one of the challenges is like, I mean, I'm not giving an excuse, but just because of the refurbishing, kind of the refurbishing, right? So the valuation is not like a plus B. So sometimes the pricing. So there was a bug which like basically led to a couple of the spare parts pricing go haywire, and then it like haywired the overall valuation as such. But having said that, I mean, I don't want to use like point well accepted, and we have put the sufficient guardrails in place to make sure it should not happen again.
Okay. Thank you. Thank you, Vishesh.
Yeah. So the next question is from Shruti Malpani. Yeah.
Hello, am I audible?
Yes, you are, Shruti. Hi.
Yeah, hi. Thank you so much for the detailed presentation. My first question is that when are we expecting to reach Amazon levels in terms of PAT and PAT margin, and in terms of months maybe, and then when do we expect crossing those as well?
Uh, so we have taken this year as a year of consolidation, as you saw, like the numbers, right? So from the peak, I would say, see, on the peak, our other channel revenue was around 35%, which has already grown by almost like 100% now, right? But this is the year we are looking at as a year of like consolidation, and we are strongly striving towards making sure that by the end of the year we are already at the revenue run rate, which was the peak last year. So yes, but till because of fixed costs, right? So till we reach there, there will be some level of like burn, which will continue. So PAT will definitely follow later on. So first focus is to reach the this. Initial signals are pretty strong, right? And we are very hopeful that in this year itself we should be able to reach those numbers, at least in terms of monthly run rate. I'm not talking about annualized. Yeah.
So for monthly run rate, probably Q4, and PAT levels probably FY27.
Yes.
Okay. Then my next question is, so the R2 license that it's pending the payment right now,
Yeah.
that's because we are expecting to clear the existing inventory first and then take on.
No. This is just like it's international payment, so it's just like with registration and staking. It's not a big amount. We'll just clear it off. It's more of a bureaucratic delay than anything else.
Okay, so it's not because of the inventory levels that we currently have.
No. It's like, yeah.
Okay.
So we should have it in like 15 days, the license.
Okay.
Okay.
Okay. Thank
We'll
you.
quickly, like, in interest of time, to make sure everyone has an opportunity.
Yeah. Yeah. So the next question is from Shinjana Mittal.
Yeah, hi. Thank you for the opportunity. Just a couple of bookkeeping questions. So for this year, if you can provide me the split for the full year FY25, the channel-wise split, how much was the offline sales and how much was the corporate sales and how much was the Amazon sales for this year? And also, if you can also help me with just the last 2 months, what was the channel mix like?
Yes, yeah. You can check. 1 minute. Yeah. So for the last year, channel mix wise, Amazon was contributing almost 60% of the revenue. Offline was not that high, remaining largely 30% was, or yeah, around 28 to 30% was coming from our website. Remaining 5 to 6% was education and other channels, right? Now, as I mentioned, like last 2 months, we are looking at a 60-40 split, where our online channel is contributing 60%, and the B2B and which is the enterprise segment and education is already contributing around 40%. That's the latest trend that we are seeing right now.
So currently 40% is the B2B, the corporate sales, right? And the 60% is the online sales from the
Yes.
website.
Yes.
Okay, got it. Yeah. Thanks. I'll come back in the queue.
Sure.
Yeah. So the next question is from Mr. Pawan Kaul.
Hello, can you hear me?
Yes, sir. Hi.
Hi. Just wanted to check what would be our burn levels for this year. And I saw that we have cash of about 18 crores. So should we be okay in terms of cash levels?
So the first question is inventory.
How much burn levels will we have for this year? Like how much?
So
Yeah.
yeah, so as of now, definitely like initially, though as I showed in the slide, the burn levels have come down, but still we are looking at around 15 percent in terms of like top line that we are currently down with, right? In terms of cash position, I would say that as you rightly mentioned, right? So I mean, we are fortunate to have like the raise at the right, like so we have cash balance, right, which is supporting. We are controlling the cost, but investing on the growth on the marketing. So we have around 8.5 CR of cash balance. We have an OD limit of 15 CR, which we are not using right now. 15, right? Right. So yeah, so we have a room there. But yes, I mean there is a burn because honestly, on a contribution margin, I think our break-even point is at least still 30 to 40% away from the top line in terms of fixed expenses as such, right? But like we are very strongly going towards that. So hopefully in S2 we should be like there, and then from there build upon that, right? So yes, I mean this year the burn is going to be, this is going to be a year of consolidation, but as of now, and the other thing I just want to call out is that right now I would say that our approach has been, we have four pillars, we are piloting each of them, like education, modern trade, distribution, and enterprise, right? And we have proven three of like them, two of them are still work in progress. Once we have proven approaches that probably we will go more aggressive in terms of scaling them, it may mean that we will have to spend more, but I think as a management, right now that's what our view is, that once we have proven the model, proven the unit economics, and that it works, right? For example, our own Bangalore store is very much on a unit economics basis, very profitable, like already profitable, so we know we can replicate this model. So that would also mean that we might see more ATL spends in the later part of the year, right? But I think so. I think in one line, if I had to say, the focus is to deliver a good top line back again and show that we are back in action. It may lead to a bottom line impact, but I think in a long run we will be able to, like, that's something, as long as we have got our unique economics and the pieces in place, we will be able to make up for that. We have headroom. That doesn't mean that we like actively we are not looking for a fundraise, but like as and when we are ready for scale, we may evaluate those options as such. So
Yes, sir. Thank you. Best of luck.
Yeah. So the next question is from Mr. Rahul Dhruv.
Yeah, hi. I wanted to check one thing, and I was looking at the gross margins for the second half, which is around 25% compared to 45. And if I take the 2.5 crore inventory loss that you mentioned, or 1.5 crore, I don't remember the number, then we are basically still significantly lower than what we used to be. So do you think that there is anything else in there that we should know in terms of gross margin reduction?
yeah, hi Rahul. So I think two aspects, right? So around like if I include the Amazon arbitration and the inventory reclassification, that's like almost adding up for us around 3.5 to 3.7 as such, right? Besides and beyond that, there was one large transaction. It was more kind of a trading transaction, almost a 1.5 CR, which we did at a low margin as such. So there was only a 5-6% kind of a margin. So yeah, so that basically does like show as a lower margin, but on the like the base business basis, if we remove these, I think we are around so around 37 to 40% is the sweet spot that we are still like seeing. But yes, I mean around 3.6 to 3.7 CR of like arbitration, like which is still in arbitration, so we don't know what will happen, right? So that plus like this 1.5 CR of like at a very low margin trading, because it was more of a back to back which we did, because we had the inventory, but then this happened. We said, okay, let's liquidate it off, kind of a thing, right? So we just sold that off at a lower margin as such.
Okay. So I just also wanted to know the four pillars that you mentioned.
Yes.
Across those four pillars, what are margins like compared to, say, Amazon?
Right. So yeah. So looking at the website, right? So Rahul, I'll break it in two parts, right? So one is your BTL, which is like you spend that, and that should be part of the unit economics, right? So on a website, I would say that we are like right now including BTL around 1 to 2% lower than Amazon. If you include ATL also, we are 3 to 4% lower, right? On a B2B basis, we are at par or probably like 1 to 2% better. Okay. Having said that, as I said, this also includes your ATL, which is for more of a brand building, right? And it will give us like dividends at a later point of like time. So, but on a unit economic basis, I would say the website is still 1 to 2% underperforming as compared to website right now.
Right. So basically,
And yeah.
So basically, we should be looking at uh, structurally lower gross in the future also, right?
At least for a year, yes.
No, I'm talking about removing the one-offs. If we should we be looking at 40%? Should we be looking at 38%?
Yeah, I would say 37, 38% is the right number.
Okay. All right, great. Thanks. I have one more question, but I'll come back in the queue.
Absolutely. Thank you, Rahul.
Yeah. So the next question is from Mr. Rohan Advant.
Yeah, thanks. I just wanted to understand now that Amazon as a channel for online refurbished does not exist. It must have been a large channel. So where is that demand gone? Is there any competitor that is trying to take advantage of that where we could tie up and benefit from, or that demand is just gone out of the market and gone offline? So any understanding of what's happened to that set of buyers who used to buy from Amazon?
Yeah. So yeah, in terms of like any major competitor eating away on the share, so because I think like none of the major ones are in refurbished right now, be it Flipkart or Jio as such, right? So I don't think in terms of a large player to large player, like a shift of the market has happened as such. My sense is like, yes, I mean, definitely 50% of the sale might have transitioned back to new or the low value news as such. In terms of like whatever the markets that we have seen, I think we have seen like 3 4 patterns. Like one, the moment this happened, like besides us there were a couple of other players. Now they have ironed out from the market, right? So like which tried to like like capture that particular market, who are also on like Amazon, right? We have grown almost 100%. Cashify is definitely like have started very vigorously focusing on laptops as and PC as a category. I'm not really sure like what is their like overall growth, but I think that's what like my sense is that unfortunately, yes, I mean, like a lot of this might have like gone or gravitated towards new or the low value or the like the not low value but like the low in terms of like rupees new as such, and we have grown by 50. Probably Cashify has taken a few, so that's what like the pattern we are seeing.
Understood. And secondly, on the sourcing side, how are you thinking about that now? When you get large deals, would you be comfortable and confident to source, because you might not have good visibility on your ability to sell in the near future in terms of volume? So how do you think about how much to source in this time?
I think, I mean, see, usually, the biggest sourcing ticket size or, the lot size would be like best to best, like 1400, 1500 units, right? So even at our current scale, that's like probably 10 to 15 days of inventory, right? Though we have like come half, right? So yeah, I mean, usually those are like the typical ticket size in terms of sourcing, right? It's just that the number of transactions have reduced very significantly because, of course, we are sitting on a large inventory any which way, right? But yes, I mean, usually we haven't done like, like a very large, like 8,000, 10,000 unit kind of a transaction, which we may make us like think that, okay, it will take us 2 months to liquidate. So, I mean, given the average ticket size, I think we are like comfortable to be able to still execute, right? So that should not like impact us much.
Understood. I'm a happy
Okay.
user of your product, and I wish you all the best in terms of going through these difficult times. Thank you.
Thank you so much, Rohan. Thank you.
Yeah.
Can we
So
have?
the next question is from Mr. Anshul Jain again. Yeah.
Yeah, thank you again. Just wanted to check any sense on what Cashify in terms of volume would be doing today. And also related question, I mean, Cashify seems to be doing very aggressive on at least keyword protection, which you are not doing. Obviously, they are a company in private space with large amount of fundraise already done. So, I mean, it looks like this is your largest competition in terms of this, and OLX is your largest competition. So, what's your, if you can just highlight on those aspects, please?
So, sir, can you repeat the first question first? Like,
Yeah. So, I mean, what is the volume of Cashify today in terms of refurbished laptop?
right, yeah. I mean, honestly, it will be my guesstimate, but I think my guesstimate is that they're like just started, right? So it's not that significant, right? Because they're like primarily mobile one, but yes, they have started focusing on that. They definitely also looked at this as a white space and providing it as a like a market space or an aggregator for like the other sellers and stuff like that. I will probably not, take a wild guess, right, key how much, but it's definitely, I would say that it's like significantly lower as compared to like ours in terms of volume share, right? Second, I think you're talking about the keyword protection online, right? Search.
Well, on Google, I was asking keyword
Hmm.
protection. If I, let's say, search refurbished laptop, this would, the first would be Cashify,
Yeah.
then second would be OLX, third would be you.
Yeah. So yes, I think those spend levels patterns will continue to differ depending on the deep pockets and the strategy that we take. Right, I think we historically had been bootstrapped. That's the reason we like. That's why we went for the listing and stuff like that. So probably being conservative is like in our nature. Having said that, we are spending, right? So we are spending on performance marketing, and we are well aware which segment demography delivers it for us. And we closely monitor in terms of the impression shares and market shares. And I think we are very comfortably like placed. And whenever we have the right inventory, we are able to get the right audience to us.
Sure, thank you. If I can squeeze in one more question, if you allow.
Sure.
So, just wanted to understand what is your, I mean, what is your target on brand marketing for this year? How much you want to spend as a percentage to NSV, or what kind of budget you have allocated to brand
So as I
marketing?
say, I think we are like definitely targeting at least 5% of our top line, right? So yes, I mean that's an over leveraging which we are going to do and continue to spend on the brand side. And a lot of this will like also start kicking in now because right now we were more on a pilot phase in terms of proving the models, be it offline, online. And once those are done, I think we will definitely go a bit more aggressive, be it in terms of franchises, distribution, or like the online models, like it's a mixed blend of a multi-channel strategy, right? So that I think we will spend at least 4 to 5% of our top line on that.
Got it.
Okay,
Thank
super.
you. Thank you so much, Vishesh.
Thank you.
Yeah. So the last question for the day is from Mr. Rahul, who will make a hard stop after that. So over to you, sir.
Yeah, hi, Vishesh. Thank you. Vishesh, what I wanted to know is, we've discussed a lot of changes that we are going through right now, and fantastic. I mean, I think it's, I mean, I would say that to have taken something so big into your stride is fantastic. But what I wanted to know is that if you look at all these changes, whether it is the four pillars, whether it is the marketing spend going up, whether it is the contribution margin being slightly lower, if we add all of that up and the reduction in employee cost that you have kind of factored in, what kind of a break-even level of sales would you be looking at on a monthly basis?
So yeah, I think if we reach back to like 5+ number, right? We should be at a break-even level as per our internal like measures that we are taking, right? 5 to 5.25 top line, we should be at a break-even level as such, right? So we expect that to come in the later part of this year, right? And then build from there.
And what is your current run rate?
So right now we are around like 3 point something, right? So 3 to 3.5 is what we are running at.
Okay, great. Thank you so much.
Thank you all. Thank you all for joining in and for your questions and your faith on the company. So with that, we'll like to end this call. Thank you.
Yeah. All right. Okay. Thank you so much.